There's a reason some of the most powerful money in Asia still flows through one city. Not loud, not flashy, not trying to impress you, but precise. Before the skyline of Hong Kong became a symbol of global finance, it was a rocky trading port. No natural resources, no oil, no massive land, just a harbor and timing, and somehow that harbor became the financial gateway between East and West. This isn't just another luxury city story. This is about how a place with almost nothing built, one of the most sophisticated international banking ecosystems in the world, how capital markets exploded here before most of Asia even opened up, and how billionaires quietly structured their wealth through a city that mastered financial infrastructure before it mastered real estate glamour. When you look at Hong Kong's skyline today, you see glass towers, ultra-luxury penthouses, private members clubs, Rolls-Royces outside five-star hotels. But what you don't see is the machinery behind it. The private banking floors, the asset management firms operating above the clouds, the deals structured at midnight between global investors and mainland capital. This city didn't just attract wealth, it engineered an environment where wealth could move efficiently. And here's the part most people miss. Hong Kong wasn't built for billionaires. It became essential to them. In this documentary, we're breaking down how Hong Kong rose as Asia's original wealth powerhouse, the systems, the strategy, the lifestyle layer, and the financial architecture that made it untouchable for decades. Because if you want to understand modern Asian wealth, you have to start here. And trust me, this story is far more strategic than it looks from the harbor. To understand Hong Kong's luxury today, you have to rewind to something far less glamorous. Shipping routes, cargo, risk. In the 19th century, Hong Kong wasn't a financial hub. It was a strategic outpost, a British-controlled port sitting at the edge of China, positioned perfectly between East and West. That positioning changed everything. What made Hong Kong different wasn't just geography, it was policy. Low taxation, open trade, minimal barriers for capital movement. While many Asian economies were heavily regulated or closed, Hong Kong quietly built a reputation as a place where money could move freely. And in global finance, freedom of capital is oxygen. Banks followed trade, then investment followed banks. Then something interesting happened. Instead of becoming just another commercial port, Hong Kong began building financial institutions that mirrored London and New York, but with Asian access. It developed strong legal frameworks, independent courts, transparent corporate structures, reliable currency stability, and stability is the most underrated luxury in finance. By the mid-20th century, multinational banks had already established deep roots here. The city was no longer just facilitating trade, it was structuring wealth. Then came China's economic opening in the late 20th century. Suddenly, Hong Kong wasn't just a port. It became the financial bridge between global capital and mainland opportunity. And this is where the wealth acceleration truly began. If you were an international investor looking to enter China, you didn't go directly to Beijing. You came to Hong Kong. If you were a mainland entrepreneur preparing for global expansion, you structured through Hong Kong. It became the financial translator between two economic systems. And here's the human layer most people don't talk about. Hong Kong's culture adapted to speed. Deals moved fast. Markets reacted fast. Wealth scaled fast. This wasn't slow, old money Europe. This was high-density capitalism. Vertical ambition stacked in skyscrapers. And as capital flooded in, so did a new class of high-net-worth individuals. The city wasn't just managing trade anymore. It was managing billionaires. If trade built Hong Kong, capital markets made it powerful. There was a turning point. The moment Hong Kong stopped being a gateway and became a financial engine, that engine was the stock market. The Hong Kong Exchanges and Clearing, better known as HKX, didn't just list companies. It became the launchpad for some of Asia's largest public offerings. When mainland Chinese giants wanted global credibility, they didn't list at home. They listed here. For decades, Hong Kong ranked among the world's top IPO destinations, competing with New York and London. Billions raised in a single day, record-breaking offerings, international investors lining up for exposure to Asian growth. And here's what most people don't realize. IPOs don't just create companies, they create instant billionaires. Founders became global names overnight. Early investors multiplied wealth at aggressive speed. Family offices formed. Private banking divisions expanded. Luxury didn't arrive slowly. It arrived in waves, tied directly to capital events. And this is where the luxury plus finance connection becomes visible. When IPO money hits, what follows? Peak property purchases, ultra luxury penthouses, rare art acquisitions, private jet upgrades, yacht memberships. But beneath that lifestyle was structure, because every major liquidity event needed wealth management, asset diversification, global portfolio structuring. Hong Kong's private banks scaled alongside its IPO machine. International institutions expanded aggressively, building entire floors dedicated to high net worth individuals across Asia. And here's something I personally find fascinating. Hong Kong didn't just attract wealth creators, it attracted wealth managers. That's a huge difference. A city becomes truly powerful when it doesn't just produce money, it organizes it. By the early 2000s, Hong Kong wasn't just Asia's financial gateway. It was one of the most concentrated hubs of capital coordination in the region. Money was being raised here, structured here, protected here, and reinvested globally from here. That's not just success, that's infrastructure. And infrastructure is what separates a rich city from a wealth powerhouse. Now, this is where things move from public money to private strategy, because IPO headlines are loud. But real wealth, it moves quietly. By the early 2000s, Hong Kong wasn't just a capital-raising hub. It had evolved into one of Asia's most concentrated centers for private banking and wealth management. Global institutions expanded aggressively here, not just to open branches, but to build full-scale Asian headquarters. You had legacy names like HSBC deeply rooted in the city's DNA. Swiss Precision entered through UBS. American giants like JP Morgan Chase strengthened their regional presence. And this wasn't random expansion, it was demand-driven. Because as mainland entrepreneurs, listed companies, and global investors poured into Asia, a new class of ultra-high net worth individuals emerged. And they needed structure, not just accounts, strategy, asset allocation across continents, currency diversification, succession planning, multi-generational wealth preservation. This is where family offices began quietly multiplying, private floors inside skyscrapers, invitation-only wealth advisory rooms, discussions that rarely make headlines but move serious capital. And here's the luxury twist most people misunderstand. Hong Kong's billionaire lifestyle wasn't just about showing success. It was about proximity to financial intelligence. When you buy a penthouse overlooking Victoria Harbor, you're not just buying a view, you're buying access. Access to deal flow, access to capital markets that operate in your time zone. Luxury here isn't isolated from finance, it sits on top of it. Walk through Central District and you'll see tailored suits, discreet watches, quiet confidence, no excessive display, just compressed ambition. I've always found that fascinating. In some cities, wealth screams. In Hong Kong, it calculates, and that calculated mindset is what turned a skyline into a financial command center for Asia's high net worth elite. But every financial powerhouse eventually faces a stress test, and Hong Kong's next chapter would prove just how resilient or fragile that system really was. Every serious financial center eventually faces a moment where the world asks, is this still stable? For Hong Kong, those moments came in waves. The Asian financial crisis, the global financial crisis of 2008, periods of political tension, capital flow uncertainty. Each time, headlines predicted decline, and each time something interesting happened. The financial core didn't collapse, it recalibrated. Hong Kong's strength was never emotional confidence. It was structural depth, the currency peg to the US dollar, deep foreign exchange liquidity, highly capitalized banking institutions, strong regulatory frameworks. While markets fluctuated, the institutional backbone remained intact. And this is something people outside finance often miss. Wealth doesn't panic easily. It studies risk, it hedges exposure, it diversifies geography. During periods of uncertainty, some capital flowed out, but capital also flowed in, particularly from those who understood long-term positioning. Because even during stress, Hong Kong remained a major capital markets hub, a leading offshore renminbi center, a gateway for northbound and southbound investment flows. And here's where the luxury finance connection becomes subtle but powerful again. When volatility increases, demand for private banking advice increases. When uncertainty rises, family offices expand strategy discussions. Stress doesn't kill financial centers. Sometimes it deepens their sophistication. I think that's what makes Hong Kong fascinating. It's not a city built on hype. It's a city built on adaptability. Yes, regional competition intensified. Yes, capital started exploring diversification across Asia. But Hong Kong's infrastructure, legal, banking, capital markets, had already been layered over decades, and layered systems don't disappear overnight. They evolve. The real question wasn't whether Hong Kong would survive, it was how it would redefine its role in a rapidly shifting Asian financial landscape. Today, Hong Kong feels different from its early rise years. More mature, more strategic, less explosive, more intentional. But make no mistake, Hong Kong is still one of the most concentrated hubs of financial power in Asia. Walk through Central and you'll feel it. Glass towers filled with asset managers, private banking divisions handling cross-border portfolios, deal teams structuring regional mergers. This city operates in layers. Public markets above, private wealth floors in the middle, family office strategy rooms behind closed doors. And while headlines often focus on competition from other Asian hubs, Hong Kong still holds something unique: direct capital connectivity to mainland China. Through structured channels linking its stock exchange to mainland markets, Hong Kong continues to function as a financial bridge, not just symbolically, but mechanically. That connectivity sustains liquidity, and liquidity sustains relevance. But here's where the luxury dimension quietly reinforces the finance narrative. Hong Kong remains one of the most expensive real estate markets in the world. Ultra-luxury residences overlooking Victoria Harbor. Members-only clubs where bankers, founders, and fund managers intersect. Five-star hotels hosting discreet deal conversations. The density here is unmatched. In some cities, wealth spreads horizontally. In Hong Kong, it stacks vertically. A billionaire might live 20 floors above the private banker managing his global portfolio. That proximity creates efficiency, and efficiency is attractive to serious capital. From a structural perspective, Hong Kong has evolved from being simply Asia's gateway to being a highly specialized financial node within a broader regional network. It may no longer dominate headlines the way it once did, but real financial power isn't measured in headlines. It's measured in capital flows, institutional depth, and wealth concentration. And by those metrics, Hong Kong remains deeply embedded in Asia's financial architecture. The story now isn't about explosive rise. It's about sustained relevance. So, what is Hong Kong today? Is it still Asia's original wealth powerhouse, or has the center of gravity shifted? The truth is, financial power doesn't disappear. It relocates, reshapes, recalibrates. And Hong Kong has spent decades building something far more durable than hype. It built financial architecture. Architecture survives cycles. It survived the IPO boom. It survived global crises. It adapted through structural shifts. That's not luck. That's design. Hong Kong's real legacy isn't just billionaires, skyline penthouses, or record-breaking IPOs. It's the system: deep capital markets, international banking density, wealth management sophistication, legal and regulatory infrastructure, cultural fluency between East and West. Luxury here was never separate from finance. It was a byproduct of financial efficiency, and maybe that's what makes Hong Kong so fascinating. It doesn't need to prove itself loudly. It just keeps operating quietly, strategically, structurally. In the next episode, we might look at how another Asian giant is positioning itself in this same wealth conversation. and whether Hong Kong's blueprint is being replicated or challenged. But for now, the rise of Hong Kong tells us something important. Wealth doesn't just follow opportunity. It follows systems that understand it. If you enjoy this deep dive style, luxury layered with financial intelligence, subscribe and stay connected for next one